Good afternoon, everyone. Welcome, and Peter, thank you for joining me once again on the Walker Webcast. We had a terrific discussion at the beginning of the pandemic where you laid out a number of thoughts that were both controversial and, in hindsight, very accurate. First, you projected the economic impact of the virus in terms of unemployment, hit to GDP, and overall cost to the U.S. economy very accurately. Second, you compared COVID to past pandemics such as the 1918 Spanish flu and suggested that while deadly, we couldn't let a disease that was predominantly impacting the elderly shut down our economy and our lives. And finally, and very unfortunately, you predicted the social unrest that erupted in the United States after the death of George Floyd. So first of all, well done on predicting extremely accurately what has happened over the last 7 months. And second,
I'm great at predicting bad news.
Yeah, right, exactly. And second, Peter, if you look back over that period of time, what's the biggest thing you missed?
Oh, it's so obvious. You may remember I said something like, without jobs, without confidence, and without a down payment, single-family housing market's going to collapse. Because if you don't have money for a down payment, you can't get a loan without a job. And I thought single family housing would just utterly collapse. And it dropped. There was a notable drop in April, May. But as you know, single family has been one of the brighter spots, not the brightest, but one of the brighter spots, especially suburban. And I missed that. And if you say, why did you miss it? It's very simple. What I missed was that involuntary savings occurred. What was involuntary savings? You had your vacation plan to go to Disney. It was canceled. Suddenly you had that money, and you had all kinds of involuntary savings occurred. You didn't make that trip. You didn't have to pay for parking at work, et cetera, refunds on your concert tickets, whatever it was. And when you go through the math, in 6 months of savings, largely involuntary savings, people had a down payment that would have otherwise taken them 2 or 3 or 4 more years to get. And I think people looked around and said, oh, I've got a down payment available now. I'm going to buy a home now rather than 2 years from now or 3 years from now. Interest rates are low. But I missed that totally. It was just, who knew that this involuntary savings would be such a dramatic effect?
So for the rest of our conversation, I'm going to dive into data that's in the Linneman letter. And to those of you who are watching today who do not either get the Linneman letter or read the Linneman letter, I would strongly encourage you to do so. It is jam-packed with incredible data that if you take the 6 or 8 hours that I took over the weekend to dive into it, you can, 2 things. 1, fall asleep really quickly. And second of all, learn a heck of a lot about the economy we're in and what's going on in the world. And so let me start, Peter, with the economic damage done. I don't want to look too much backwards, but I think it's important for you to bring us and kind of set the table again on what's happened in the pandemic and then where we're going to go from here. So as far as damage done and where we are today, you estimate that 55 million people lost their jobs during the shutdown, and that while the official unemployment numbers from the Bureau of Labor Statistics currently sits below 8%, that isn't the true unemployment number. What is the true unemployment number today? And why do you say in the Linneman letter that the economy feels much weaker today than it did in 2009 with 10.3% unemployment?
Sure. So the unemployment, by the way, nobody is intentionally lying to you. It's not like the government is, there's not some conspiracy. It's that the data collection was never designed for what we just went through, and for a whole lot of technical reasons. And so when you get the official unemployment rate, you get like it's not that bad. Well, go to Vegas and it's bad, and go to Orlando and it's bad. I mean, really bad. And go to New York and the restaurants are really bad. And so far worse than anything you saw. And so it is worse. It is worse. The unemployment rate today, as best I can estimate it, and I do it 2 or 3 different ways, if you use the size of the labor force at the end of February. And by the way, remember that labor force would have grown over the next 8 months, just from population and so forth. If you use that, we're probably at about a 14% unemployment rate. And the reason the official is lower is people dropped out of the labor force because they can't find jobs. What's the point? You graduated from high school in June. What's the point of even looking, right? So the labor force dropping, those people would be working if the economy was good. And the second part is a whole bunch of people who have been furloughed basically answered that they're employed even though they're not. And it's not like there's anybody trying, the BLS is aware of this. It's not like they're dumb. But in apples to apples, if the unemployment rate was 3.5% at the end of February, which it was, in a comparable labor market sense, it's around 13 to 14% today. Today, literally, as we sit here.
So your numbers right now are a net loss of 8 million jobs in 2020, followed by gains of about 3 million next year and the year after, and then down to 2.5 million for the subsequent 2 years. And with manufacturing jobs today only representing about 9% of U.S. jobs and all the real gains coming back in the service sector, what are your projections as it relates to, you've got 3 million jobs coming next year. Is there anywhere that you're looking and saying, this service sector is going to start to recover in this area? Is there any guideposts to where you're projecting these jobs to come back?
Well, I think in our second talk, Willie, I said the sector that would come back the strongest was going to be medical health care. And that was certainly true. Medical health care has come roaring back after a big drop. And that has been a big driver. And that's service, obviously, and that will continue. The sector that needs a lot of help are travel, leisure, entertainment. And they need us to feel confident. They need improvements in treatment if you get the disease, and they need probably some help vaccine-wise or otherwise. And those are big sectors, travel, leisure, and entertainment. I mean, Vegas and Orlando exist for travel, leisure, and entertainment. New York, Times Square existed for travel, leisure, entertainment. And we can go on and on. And international travel is zero. Well, that's not good for New York. That's not good for DC. So until those things come back, those sectors can't come back. They can't come back without that. And all you have to do is look at the NFL stadiums, right? You get a real good sense of how far back that sector is. Half the stadiums have 4,000 or 5,000 people in them, right? That gives you a barometer. Watch that. When that's back to 70,000, we're back, okay, in that sector. Unlike China, services is a big part of our society. And so it's much easier, I'm not saying easy, much easier for China to come back than if all you are is a service sector. And we're not just a service sector. The other service sector, it's not categorized as service, but it is education. And yes, not everybody, lots are doing virtual. What about the janitor? What about the supply, keepers and all that? So education being where it's at, which is largely virtual, that's holding back that whole sector from recovering jobs. So those are things to watch. If I had to give you one thing to watch that's fun, watch NFL attendance. And I don't mean just this year. I mean, even if you're not a fan of the NFL, turn it on and see how many people are in the stadium this year and next year. And when they're back, we're back. We're really back is the way to view it.
So your projection is that we'll lose 2 trillion of GDP this year and that won't be back in the economy for another 2.5 years. And what you just said as it relates to the service sector and travel and leisure coming back and NFL stadiums getting filled back up. But is there any chance, Peter, that you're looking at, if you will, traditional economic activity, and that as we have adapted to this new online activity, that I mean, you look at the stock prices of some of these companies that are quote unquote benefiting from the pandemic. Is there a chance that, I don't know, Netflix and Amazon and Facebook all drive so much additional economic activity that they offset the fact that Delta Airlines is flying at 50%?
I don't think so. They are offsetting some of it. There's no doubt, but not that much. We're a social being. We're going to travel. We do want to go to ball games, etc. But we want to do it safely, and that's going to take a while. And even after it is safe, it's going to take a while for us to realize it's safe. And you don't go out the second the blizzard ends. You wait an hour or two to make sure the blizzard's really over, because I don't need it that badly. So yeah, I include that. I think it's unlikely by the end of next year we're back. I think it's into 2022, and largely because of this education, travel, leisure, entertainment is a big part of our society. We got the huge advantage of medical coming back, medical health care coming back. And it's not 100% back, but it's come back pretty close to 100%.
So as we talk about the loss in GDP and the amount of debt that was added to the federal government's balance sheet, which at your writing is about $8 trillion of additional debt, there's a
It will be about $8 trillion. It's only about 2 at the moment, but they got a bill of about $2 trillion they're going to pass. That'll make it 4. And they're going to do 2 more in the next couple of years, is my gut. And we end up at 8 all told.
Okay. So in your letter, you write this statistic that I gotta state, and I gotta state it slowly so everyone grasps this. But you state that in July of 2020, total real monthly federal government net interest payments stood at $26.3 billion, only $1.2 billion above federal interest payments in August of 2008.
Yeah.
So even though we have added $15 trillion of federal debt between 2008 and 2020, we have only added $15 billion of annual interest payments. With those kinds of numbers, shouldn't we have passed the next stimulus bill back in July?
Well, that's politics. That's not economics, right? And that's, interestingly, the first Recovery Act was the least political government spending I ever saw. And by that, I mean, not only was it not terribly Democrat Republican, it wasn't your district is a hot district, you're chairman of the appropriations committee, et cetera, right? It had none of that. It was just, we're going to go out. This bill that there's talking about, a little less so, more political. The one after that will be even more political. The one after that will be even more political. Look, people ask this they ask it well, but it's a stupid question. Can we afford any debt associated with this? And I say, wait a minute. Of course we can. And I say, that's why I use the $8 trillion, Willie, is that would be 4 times where we're currently at. So we do the one we're talking about and more. 8 trillion would be at the top. GDP is 21 trillion. If we put that debt in, total debt would be about 25 trillion and GDP would be 21. Can real estate guys pay off all their debt with a year of income? Not likely. The country can, basically, is what I'm saying, right? Second, your point, when you calculate the interest cost of that additional debt, it's like 100 billion. And that's if it's 8 trillion. It's 100 billion a year. 2019 government budget was 4.3 trillion. It's rounding error. Another way to view it is net household wealth is 115 trillion. 115 trillion. And we owe foreigners about 15 trillion of federal debt. That means we take our 115, we pay the foreigners the 15 we owe them, and we still have $100 trillion. We can do that. And the fourth way is do the present value of the U.S. economy, present value of U.S. GDP. So that's around $800 trillion. $800 trillion is around the present value of U.S. GDP. That's equivalent to the value of a building, right? The present value of future income streams, right, is 800 trillion-ish. 8 trillion is 1%. Of course, we can afford 1% shifted from the future to today to help out pain and suffering. That's not the question. The real question is not can we afford it, but who's going to pay, right? And I want you to pay, Willie.
Yeah.
You know, and Willie wants the guy in Seattle to pay, and the guy in Seattle wants tall people to pay, and the tall people want short people to pay. It is not an issue of can we pay. It's I want everybody else to pay. Everybody sitting in the room pointing, you pay. And that's why we have politicians, unfortunately, is to decide who pays. And that is a hard issue of who pays, but not if we can afford it.
So as you look at that amount of federal debt outstanding, obviously rates come into play, and where are rates going to go? You state in the most recent Linneman letter, quote, rates will remain low for years to come as global monetary authorities will repress rates to keep government debt affordable. And you even note a very, you have to be sort of a Fed watcher like you are to be able to pick this up. But in their last notes, where they moved off of a set target of 2% inflation to an average inflation rate of 2%. Can you talk about that shift, and then also give us a sense of where, if you say for years to come rates to stay low, give us a projection of rates for the next 2 or 3 years in a range. Just kind of, are we talking about that the 10-year could go to 150, or do you cap it at 2? Give us some sense of what.
I can't see it. Let me do the backwards way. I can't see it going above the 10-year, going above 2 for 5 years or so. Now, you get beyond that, you have a whole change in officials and so forth and so on. I just can't see it. And the reason being that it is actually twofold. One is a belief, right or wrong. I tend to disagree with them, but that's beside the point. The belief of the people in charge is low interest rates stimulate the economy. And as you know, as a past reader, I think in some ways they hurt the economy. They help borrowers, but they hurt savers. And I don't know why borrowers are more noble than savers. So I don't see how hurting one person by $1, but helping another person by $1 stimulates. There's a long discussion, but that is the prevailing view. And that's going to be there for 4 or 5 more years. And the second is that whether they explicitly say it or not, they're going to help the government cover their deficit in the way we were just talking about, by keeping interest rates low. And this is very similar to what happened after World War II, and what happened in many countries where you can repress rates, and it will hurt the economy in the long term because, look, let's face it, it makes government debt cheap. That's good, but that means it encourages the government to be the spender rather than you. And at the end of the day, in normal times, I'd rather have you deciding what to spend on than a politician, because you're doing it on an economic basis and they're doing it on, I'm the chairman of the Appropriations Committee. And therefore, they're trying to buy votes, you're trying to buy goods and services. And so in the longer term, it will hurt the economy. In the short term, it doesn't matter much because, and I don't mean this in a Keynes sense, but in a short term, nothing has a big impact if it's only done for a short time. But they're going to do this for a long time. Let's say 5 years. And if you said, I think it has a hard time getting above 1.5% on the 10-year over that period.
And what's the outlier, Peter? In other words, as you probe at that, what if inflation starts to run? And a lot of people sit there and say, okay, but there's excess capacity in the labor markets. There's excess capacity in the manufacturing markets. So you sort of say, well, that's not going to tip it because we're not going to get inflation. The dollar is still the reserve currency of the world. There's really not a competitor to the dollar. So you're not going to see people investing in euros all of a sudden as the reserve currency. Is there something out there that's a curveball to these rates are around us for 3 to 5 years?
There are two. One is if a set of Fed appointments occurred, like a Paul Volcker, that was a sea change in the view of the world at that time, so that they would say, I don't think keeping rates low is stimulating the economy. It's hurting savers, and that would be a sea change, right? I don't see that in the near term, but that would be a sea change if you had that. The other is, no, I don't think you get big consumer inflation. People make a mistake. They say we've had no inflation for the past decade, and you're dead on about currently. There's a lot of excess capacity and so forth. But let's take the 2009 to 2019, and people say we had no inflation, and that's wrong. We had very little consumer price inflation. But what happened to the price of gold? What happened to the price of stocks? What happened to the price of homes? What happened to the price of apartment buildings? What happened to the price of warehouses? We had enormous asset price inflation. Why? Because we put a lot of money into the system during the financial crisis. It didn't come out immediately. It came out slowly over the subsequent 7 years, 8 years, and it didn't go to goods and services. It went to asset prices.
Right.
And what I think will more or less happen is the same thing. We put a tremendous amount of money in the system with QE infinity, and which is really what it is the Fed has said, we're going to put in whatever amount of money we need. Forget 4, 5, 6, infinity. And it won't come out immediately, but it will come out somewhere. I just don't think it's going to come out much in consumer prices. It's going to come out in asset prices. And I think in a way, a decade from now, we're looking at the same kind of run in asset prices that we witnessed, and we'll say there was no inflation. And you go, wait a minute, there was tremendous inflation, but it was of assets, not goods.
And we'll talk about single family housing and supply and the affordability index in a moment, but obviously that plays into that picture dramatically as well. But before we get to that, while we're on interest rates, federal debt, one of the other things that many people are focused on is the corporate tax rate. And there are a lot of people, a lot of market commentators talking about what rising tax rates will mean for the economy if Biden is elected president. And you provide a data point in the most recent letter that I still have gone back and reread about 5 times and still need you to explain it to me because it's an incredible statistic. So you say that in Q2 of 2020, corporate profits in the United States stood at $1.6 trillion, or 18.7% below their peak in nominal terms in 2014. So in nominal terms, U.S. corporations brought almost 20% less to their bottom line when the corporate tax rate was at 35% versus 21% today. And you go on to give another statistic that says that as a percentage of GDP, corporate profits were at a peak in 2012. So again, in 12 and 14, you have a 35% corporate tax rate. In 2020, we have a 21% corporate tax rate, yet you're basically saying that corporations are making about 20% more back then and bringing it to the bottom line. How can that be?
So think about when the peak in corporate profits as a percent of the economy were. 2012, I'm doing off the top of my head. I think you're right. That's because we were still having technological progress. We still had productivity increase, but labor was plentiful. And as I say, the prevailing view was productivity occurred. Who gets it? The capital or the labor? Well, if labor is plentiful, it goes to capital. The beatings will continue until morale improves. What are you going to do? And then things start changing and labor markets start improving. And what history shows is as labor markets improve, productivity gains go to workers. And you saw that in 2016, 17, 18 dramatically, that the gains went to workers. And I'm sure you had to do it, right? I mean, you had improvements, but if you didn't give people more money, they could actually leave. We're now in a period where profits will rise because the beatings will continue until morale improves. But by the way, once things tighten up, those gains will go back. Does the tax rate matter? Sure. There's a lot of research, and it does. If I were to summarize all the research by everybody serious on corporate tax rates and economic growth, the answer is, yeah, lower taxes lead to more growth. And the way I view it, Willie, is let's say you lower taxes and 90% of the companies do nothing different. You do nothing different, I do nothing different, but 10% of the companies do 20% more, right? That's the nature of how it's coming. It's not like every company is doing more because of lower taxes. It's that a company comes into existence, a company expands discreetly. So the research shows clearly that lower taxes do encourage economic growth. Same on the individuals. We do know probably 90% of the people will work the same amount of hours as long as the tax rates are in a certain band. On individuals, if they push beyond that band, 95% tax rates, you'll get a change. But 10 or 20% will work more at lower taxes. So when people say what will happen if we raise taxes, we will get lower growth, but it's not night and day. And by the way, you know it's not night and day. I'm 69 years old, and I've seen taxes high, and I've seen taxes low, and I've seen taxes in between, and I've seen some, and we grow. You've seen those GDP charts in Linneman letter, right? You go back and tell me when a Republican was in, you go back and based on that chart alone, right, of GDP, you tell me when taxes were high or taxes were low or Republican Congress, or can't do it, right? It just grows. The growth differential is small. Now, think about it. 20 basis points for a year is nothing. 20 basis points for 30 years would be a lot, okay? And what has happened in the U.S. system is, so I get 20 basis points lower growth for a couple of years based on tax policy, and then the pendulum swings, and we get 20 basis points more of growth, and we make up a bit, and that's probably what will happen as we move forward in life. I hope I'm still around when I'm 109, and I get to see 40 more years of that.
So you mentioned Paul Volcker recently, just a moment ago, and I actually, when I read that stat, I went back to see what the corporate tax rate was during the Reagan years, because many of us believe that the Reagan years was a big financial success. And for the first 6 years of the Reagan administration, the corporate tax rate was 47%.
Yeah.
It was dropped down to 42% in 1987. And then it went to 39 in 1988. And so it was just interesting to see that we've come from there down to now 21. But to your point, it's really very difficult to look at those charts and figure out what tax rates you actually have in place based off of GDP growth. You also mentioned, Peter, the growth in average household income. And just to give numbers to people who are watching, because you know these, but in 2012, average median income in the United States was $56,300. And in 2020, that number is at $64,600. So up almost 15%. So just underscoring your point about what has happened to average household wealth and income over that period of time as corporate profits have come down, those, if you will, riches have gone to the American consumer, to the American worker.
Yeah, and in fact, as you know, in 17, 18, and 19, the largest income growth as a percentage were going to the lower tiers. And that's because jobs were plentiful, economic activity was plentiful. So that happens. By the way, one of the other things, and I won't go into it, but people need to understand about all this inequality kind of stuff. Inequality has to rise over time in our society for statistical reasons. And you go, what's that about? Well, when I was 16 and I got my first job, I knew nothing. And they paid me as if I knew nothing. By the way, a 16-year-old who gets a job today also knows nothing and gets paid like they know nothing. But the 40-year-old of today gets paid like somebody who has all that productivity growth that occurred over those years. Whereas the 40-year-old when I was a kid got paid for the productivity that existed then. So you can imagine the bottom, and just think of a 16-year-old kid when you think of the bottom. They're all the same. They know nothing. Over time they do, but at that moment. And everybody else moves up. So just imagine a society where you constantly have new idiots getting zero for a short period while everybody else moves up. Of course, inequality would go up for that. And the other thing, I have a book that will come out next year, National Geographic Publishing, with the head of wellness at Cleveland Clinic, Mike Roisian, and Al Ratner. And us living longer, we know life expectancy has gone way up. Just think of the power of compounding, what it does to inequity. Namely, if you live an extra 10 years, your wealth got to have 10 more years of compounding than when we used to die young. So there are other issues, but those mechanical, and people don't even think about those.
So I want to talk for a moment about the banking system and the consumer right as we went into the pandemic and the downturn, because the data that you provide is exceedingly compelling to say that we were extremely well positioned, potentially, well, better positioned than ever before heading into the pandemic from a banking system standpoint and from an individual sort of debt to equity ratio, if you will. So on the banking system first, you mentioned that, up until 2008, the banks had zero reserves at the Fed because they were constantly taking that money and putting it out into the market. And because of Dodd-Frank and a lot of other regulatory measures, banks are now required to hold reserves at the Fed. And going in February of 2020, there was $1.5 trillion of excess bank reserves at the Federal Reserve. And that by May, with QE infinity, that number had gotten up to $3.2 trillion of excess bank reserves at the Fed. I read that data point, Peter, and you make a very well-articulated, long sort of proposition that because the banking system is so well capitalized, we are not going to see the foreclosures that we saw in the great financial crisis, that most loans will go into forbearance and be worked out because of the huge amounts of capital. And therefore, there aren't going to be that many distressed opportunities for people to pick up. Can you talk about, do you worry about bank losses and bank failures this time around, or do we just have so much capital there that should be completely in the rearview mirror and it's more of, are there going to be opportunities?
We changed our banking system. And while Dodd-Frank wasn't perfect, it did do this well. It meant that if loans can't be serviced, you don't have a systemic collapse because there's so much reserves that you don't have to call the loan. You don't have to, put it on the market at distress to meet your regulatory standards. And by the way, they've eliminated reserve requirements even on top of that. So I got this one right starting about 3 years ago. I was writing that when the downturn comes, this will be very different because of all these excess reserves. And as you say, they've pumped more in with QE infinity. So here's the scenario. Interest rates are essentially zero. I'll charge you 150 over. I'll do a 2-year loan over 150 basis points on the 2-year. And you can service that. And if you can't service that, you probably have negative operating income. I'll come back to that. So I won't even push the can down the road. I'll actually make a new loan that you can service at 150 over the 2-year, right? Because the 2-year is so low, so the bank can make money. You don't have to face foreclosure. You don't have to face, I can roll it over. I can do that. You can cover all those things, right? And at the end of the day, what the bank really cares about is covering, right? They just want to have their money. So you won't get big foreclosures. And you add to that, the Fed is saying, don't foreclose, idiots. We gave you all this reserves for a reason. Don't foreclose. And don't worry about your tier one capital. Just don't do dividends or buybacks. Okay. So banks, not just with real estate, banks are forbearing. And in fact, the only financial bankruptcies you're seeing, I'm not talking about the restaurant that just discontinued operations. They're with bonds, right? If you look at the companies who have gone into bankruptcy, it's because of bonds. The bank part of the line of credit, they're forbearing. It's the bonds. And you got to renegotiate. So what does that mean? That means in real estate, you'll see, I think, opportunities in two areas. CMBS, that's our bond, right? And they're not set up to forbear easily, right? So you have to renegotiate and do something, and foreclosing is part of that. And the other is negative operating income, because it's one thing to say, I'll forbear and I'll charge you 150 over on a zero interest rate, essentially, right? It's one thing to say that, and you can cover it, and I'll do it for 2 years, and then by the way of end of that, I'll do it for another 2 years and so forth. It's another thing to say, I'll fund your operating losses, but I'll let you keep your equity. And I don't think the banks are going to do that. I don't think they're going to fund they might fund temporary operating losses like TIs or something. And what that means is opportunities for recapitalization, rescue money, foreclosures are going to center around negative operating income. And negative operating income is going to be high-end hotel. I mean, you can tell me better. I can tell you. High-end hotels, weak retail, not so much strong retail, they can cover, right? But weak retail, and office buildings that had the misfortune of losing a big number of their tenants so that they couldn't cover anymore. And it could actually be a good office building, but they just had the misfortune that they lost enough tenants that they can't cover in that window of time. It also could be a bad office building. You tell me, those are the main places you'll get negative operating income. That's where you're going to get opportunities, because the banks aren't going to fund those negatives. You're going to need rescue capital, or you're going to get foreclosed on. And then the buyer or the rescue capital has to say, how many years of negative operating income do I have to budget for? What can I pay for the residual? That's how I see it playing out, at least.
So off of that, you do mention that the large excess reserves at the money center banks, the massive QE activity, and the $147 billion in real estate private equity, dry powder targeting North American commercial real estate, that you expect cap rates to revert once the market recedes and investors gravitate towards core and core plus strategies. So I guess the question there is, what causes the market to thaw, in the sense of, we got an election coming up, we're waiting to see if there's a vaccine, we got another stimulus bill. I can keep going down the uncertainty out in the market today. But as I look at your projections pretty much across all commercial asset classes, Peter, you are modeling out sort of peak vacancies in sort of Q4 2020, Q1 2021, and then you start to see absorption rates and occupancy levels go up, absorption rates continue to go. What's it going to take?
So that's because pipelines shut down. The economy grows and the pipeline of construction shuts down. Look, I think there's one of the most important pieces of research I've done in my career is with Matt Lariva of FCP, and it's in the current issue about cap rates and what drives cap rates. And it picks up on some stuff I had started talking about 5 years ago. It's not about interest rates, it's about flow of funds. It's about how much money is out there. And the mental experiment is simply, imagine there's twice as much money chasing real estate a year from now as today. What will happen to prices, irrespective of interest rates? You say they're going to go up, right? Cap rates would come down. So, and that's what that research that we summarized, and it's more sophisticated than what I had originally done. Matt brought a lot to the table that way, shows. And now you're back to where we were. There's a lot of money in the system. And I don't know if it comes out next year. I don't think it comes out this year. But I think by late next year, it really starts coming out. It's going to chase. At the same time, income is going to be improving, right? Because the pipeline empties of construction, growth occurs. It'll be slowest in hotels, right? It'll be slowest in anything travel, entertainment focused, like tourist hotels in New York, right? But the income will rebound, and you're going to see notable price increases, and cap rates will come down. Right now, we're in an odd period with office buildings and retail and a little bit senior, which is we lack imagination. We as a species lack imagination. We think we do, but we lack imagination, right? And by the way, if we had great imagination, we wouldn't be surprised by what magicians do. We'd say, of course, right? We lack imagination. We kind of say, how'd they do that? And as you know, if you ever know how a magician does it, of course, if that's how they did it, right? And the lack of imagination right now is no one's ever going to work from an office again, right? No one's ever going to work from an office. That's nonsense. That's just nonsense. We couldn't have been that wrong. We're social beings. And you're going to hit a tipping point. And the tipping point you're going to hit on office is, I don't know if it's 60%, 65%. When most of the people are going to my office, I got to be there too, unless I'm a vulnerable health-wise, right? Why? I'm afraid they're talking about me. I'm afraid I'm going to miss the opportunity. And I want the social. Right now, nobody's at the office. So what the hell's the point of going in? There's no social. So there's a tipping point, and I think that tipping point is some combination of psychological and medical. And as you noted, going around your office, it's very different, the psychological in different places. But what will solve it for office is when they don't have to use their imagination, imagining people to come back to work. What will solve it for hotels is when they don't have to have imagination that people will travel again, and that international travel happens again. And that's why it's out there farther. What solves it for retail is when people feel very comfortable to go back and shop, and they're allowed to go back and shop, and the restaurants are operating full capacity. And you don't have to have imagination that they'll go back to full capacity. And yeah, I think it's several years still, but it's a lack of imagination. Most people just lack. By the way, on the lack of imagination, Willie, it's one of the reasons why protectionism exists. I can see the jobs we're losing, but I can't imagine the jobs that are being created in its wake. When farming was the dominant way of employment, we had, machinery come along. All we saw as machinery got rid of the young men working on the farm and the young women. We couldn't imagine that they'd be doing what you and I are doing. Right. And that's what's going on now, is a lack of imagination.
So I want to ask one other point when you mentioned the construction pipeline falling apart, and get your quick comments on something you said in the letter, and then I want to loop into asset specific stuff. But as it relates, you warn investors, Peter, to not purchase assets well below replacement cost due to the fact that construction costs are going to fall between 10 and 25% over the next 24 months, and as development pipelines go through the floor. You want to expand on that a little bit?
Yeah, obviously you want to purchase below replacement cost. But the real thing is, just because you think you're purchasing below replacement cost today, and by the way, I started saying this 2 years ago, that when construction costs were at record highs, because construction costs fall during every downturn. The construction pipeline shuts down. The construction loan activity, even in multifamily, construction loans are way down in multi. The only area where they probably are anywhere near norm is industrial. And even there, they're down. But office, way off and so forth. So as the pipeline empties, the trades have no work, and they cut their rates. And the building supply vendors have no pipeline. They cut their rates. And so if you look at the history of construction costs, during good times, it runs faster than inflation, and in bad times, it goes down. Historically, it averages over the long term about 1% rise in real terms, 1% faster inflation over the long term. And we're in one of those cycles where it's going to go down. So just suppose you think it's going to go down 10%. And you buy a building today and you say, I'm 10% below replacement cost. My answer is, no. You're at replacement cost. You just don't know it.
Okay. So then as you look at REITs, on your capital asset pricing model indicated that REITs were undervalued by a stunning 63% in March of 2020 and have moderated to only being undervalued by 24% in September. So
right.
What do you like?
Almost everything. And in fact, the irony is the one you like least. By the way, this is not for a 3-month hold. This is for like a 5-year hold. This is a fundamental, if you will. The one you like least is industrial because it's fairly fully priced. When you do the same analysis on it, it's fairly fully priced. It's a little underpriced. Unless you think retail disappears, unless you think offices disappear. And that goes back to the imagination issue. And I just can't believe we were that wrong in February. I just can't believe that we suddenly in March came to the realization we don't need half of the office space in America. We just couldn't have been 50% inefficient. That's just defies credibility. 5% maybe. So, and the same on retail. And in fact, the good retail will ultimately end up being helped by this. Why? Because all the crap retail gets closed and you get consolidation in the better. And by the way, the REITs don't own the crap retail. Somebody does. The nail salon in the crap retail went out of business. There's nothing left in the crap center anymore. It's gone. People still need to get their nails done. They're going to go to the good center to get their nails done, right? And I'm just kind of pointing out the obvious that getting your nails done doesn't disappear. It may temporarily, but not permanently. Getting Chinese food, the Chinese restaurant went out of business in the crap center. People are still going to eat Chinese food somewhere in a year or two, and it's going to be in the good center that it will be. And the crap center will end up empty. And that's the nature of things. So what people forget is, yes, retail is challenged in the moment, but the nature of competition means that will ultimately make the surviving retail stronger, the surviving retail properties stronger. Same for hotels, same for everything.
And so on that, you may have seen that Starbucks is out buying up or taking additional space next to their existing stores so that they can transform their retail strategy. And all they're going to do is cement their position as the only brand in coffee and that sort of space going forward as these weaker retailers fall out and they gobble up their space. But on this, Peter, there's a data point that I've repeated in the last 3 days to all of my colleagues at Walker & Dunlop, and nobody can believe it. And it's out of your letter. And it's that you point out that in Q2 of 2020, retail sales in the United States were $1.3 trillion. Of which e-commerce accounted for 211 billion, or an all-time high of 16.1%. Now, before I got to the 16.1%, I sat there and said, e-commerce, I mean, the only person I saw during Q2 was my family and my UPS delivery man and my FedEx delivery man. And here it is that you're saying an all-time high in Q2 when the world was locked down and we all thought we were only getting everything from Amazon and from Walmart.com, and it peaked at 16.1%. And I think that stat says a lot about the strength of bricks and mortar and the fact that the retail is not going to evaporate.
Well, I come away from the shutdown, the extreme shutdown, right? That kind of 4-month shutdown. Not disappointed in brick retail, but amazed by brick retail at what e-commerce could not do. Not at what it could do, but what it could not do. It could not sell groceries profitably. It can sell them, but not profitably. and you go, I always thought that was the case. We had a perfect storm to test it. They failed the experiment miserably. I always thought that there were tremendous amount of goods that it's going to be years and years and years before online can compete with brick. And you know what? We found out that's true. There are some things that can be disintermediated, but most not. So what does that say? What that says is the retail that survives is going to be around that part that is very difficult to disintermediate. And in a funny way, all you did was time shift. Some of that growth that you mentioned in e-commerce, that was going to occur anyway over the next 4 years. It all occurred overnight, but it's not going to occur overnight again and then another occur overnight again on top of that. They kind of grabbed it. And having grabbed it, they can't grab it twice, right? They already got it. And what we did was find out what brick does really well that e-commerce at least can't come close to doing. That's going to make surviving brick much stronger in retail.
So on the multi-sector, Peter, you're in the letter you state that you're quite bullish on the outlook for multi. As you know, I had Mark Zandi and Ivy Zellman on over the past 6 weeks on the Walker webcast, and both are very bullish on single family. You mentioned at the beginning of the webcast that the strength in single family was one of those things that you hadn't predicted to have happen. But rent rolls have held up extremely well in multi. I've given stats throughout the pandemic as it relates to Walker Dunlop's loan servicing portfolio, and it's unbelievable. We have the largest Fannie Mae multifamily loan servicing portfolio in the United States of America at Walker and Dunlop, and we have one loan in forbearance today. One, okay? And one of the things that you point out is that going into the pandemic, the American consumer as a debt to income ratio was actually very healthy. And the stat you point out there is that debt to income ratio peaked at 13.2% back in 2007, probably not a big surprise to everybody, and had come down to 9.7% in Q1 of 2020. So people's personal debt was down at a very, very, if you will, from a historical standpoint, manageable level going into the pandemic. But even so, we haven't gotten a stimulus bill or additional stimulus since August. So we've gone through August, September, and now halfway through October. Rent collections have been extremely strong. And there are a lot of people sitting there going, how long can this hold up? Yet you're quite bullish on multi. Why are you so bullish on multi?
Well, I'm bullish on multi. If you go back to what I got wrong on single family was big involuntary savings. Well, slowly those involuntary savings are going to disappear. Why? Because people did take a vacation at the shore, right? They did go to the mountains. They did that meant that involuntary savings, remember, people could have decided to save more, but they said, I'd rather have the vacation. I'd rather have a new car, whatever it was. As their lifestyles go back closer to what they used to have from a spending point, the savings go down and they need those savings for a down payment. Down payment, Susan Walker and I did, I think in 1990, what was considered a path-breaking research that says income is not the problem. Income determines how much home you buy. It's down payment. If I don't have a down payment, even if I have the income, I can't buy. So the surge in buying single-family home is being driven by the involuntary savings. As the involuntary savings disappear, you go back more to the world we knew, which is I can't save enough. It takes me forever to save because I try to live a high lifestyle. Now, there'll still be some involuntary savings going on because the NFL only has 6,000 people instead of 70,000 people. So there's some involuntary savings going on. But, and the other thing is you still have a lot of young people. If you look at the demographic coming in, yes, there are a lot of 34-year-olds moving out, but there's almost an equal number moving in to take their place. So you still have a lot of young people. It'll skew a little suburban for the next couple of years. It'll send a false signal that everybody's leaving the city. They're not. What you're going to have happen is everybody who was going to leave the city this year, next year, and the year after are going to leave this year. And again, it's like the e-commerce. You can't do it twice. If they've already left, they can't leave again, right? So you're going to have everybody who is going to leave in the next 2 or 3 years, quote, leaving this year. But that means next year nobody's leaving, and anybody coming is a gain. So you're going to get some skewed data out of how much strength in the suburbs. I've always been pro suburbs for the multifamily because they've always had more growth of young people than the cities. But look, I mean, the fundamentals are young people don't have enough savings to buy a home. That's the fundamental.
And you underscore that by pointing out that the NAHR Wells Fargo Housing Opportunity Index has come down dramatically. So that index, which is basically at the average median income, which is now $64,600 in Q1 of this year, that you currently only 59.6% of all new and existing single family homes are affordable to the median household income. That's down from almost 80% in 2012. And so one of the things that I look at that number and say 80% of the single family homes in America were affordable to the average wage earner back in 2012. And we went through an 8-year period where multi completely outperformed single. And now all of a sudden we're in a recession depression. People have clearly moved into single family, but to your point, what are the legs behind this, particularly as asset values continue to rise and incomes either stay flat or go down?
And if I'm right that the next decade is asset price inflation, kind of a repeat in the sense of asset price inflation, that's going to get worse, right? That affordability, because my income is not going to go up so much, but the asset prices are. And that includes single family home. And you're going to get the down payment I need being even bigger. That was one of the problems that happened in the past decade, is the asset price inflation outstripped wage growth. And therefore the down payment I needed was bigger. And that's hard to put together. And I think you get a bit of a replay. I mean, I think single family does okay. It's not like I think it's awful. But multi is well suited, and the other side of multifamily has always been supply shuts down pretty quickly, except for urban high rise. That's always been tricky. But if you leave urban high rise, which is not much of multifamily, as you know, it's the photograph, but it's not the mass of multifamily. The pipeline shuts down pretty quickly in multifamily. That's one of its saving graces. Bad for developers, but good for owners and lenders on multifamily.
So my final question, Peter, and this is, I've loved asking you all these questions about all the data because the data is so rich and great. And you've helped, personally, you've helped me understand a lot of it and the context for it. But last time we spoke, it was sort of economy and pandemic, and you raised kind of what I would call at that moment sort of an outlier issue or a third rail, which was social unrest, that if we don't get these right, it could produce significant social unrest. And you were spot on in that. As you think about the outlook now as we head into 2021, is there an outlier issue beyond the pandemic, the election, and the economy, which are all three huge things, that we ought to keep in the back of our mind as sort of either an up or a down?
Social unrest. And by the way, I thought it was an obvious call. I made it originally in a web I did on March 24. I didn't know what would trigger it. As you know, I didn't say what. I just said if you get, nobody's in school, nobody has jobs, there's enough friction in life and society. You pen people up. You don't let them play basketball. You don't let them go swimming. You don't let them go to school, work, whatever. Not good things happen. They don't have jobs, whatever. And then overreaction. If you said to me, the outlier is what happens post-election civil unrest. And I have no idea. And I have no idea if it's from the right or the left or both or hopefully neither, that can do a tremendous amount of damage. That can set the economy back 6 months. It will not, well, I hope it wouldn't end up in revolution, civil war. I don't think that. But the amount of damage, curfews, et cetera, and do the following. I encourage people to do the following experiment with your own little sample. I won't even tell you what my sample shows. Ask your acquaintances and friends, what do you think? Do you think there'll be notable violence of some type if Trump wins? And then ask, do you think there'll be notable violence of some type if Biden wins? And my guess is, among your friends and circle, you're going to get lots and lots of yeses. You're going to get lots and lots of yeses. And the problem with violence is if it occurs, it tends to create violence. It doesn't tend to eliminate it, right? So if you look around the history of violence is, if it goes on too long, you even forget who started it, right? It's just, so what I really do worry about, and the lag that may well occur between the election and the result could foment it. That is the big economic wild card.
And so on that, just one final thing, because we've run out of time, which is just this. There are a lot of people who are trying to bet on a Biden economy versus a Trump economy. And I watch Squawk Box every morning and everyone's like, well, these are bets that people are thinking this happens and these are bets that people, how do you handicap your scenario of, I just ought to take my money out of the market and put it on the side until I have got a clearer picture?
Well, I think as long as you're a long-term investor, I wouldn't, quote, take it out. Because then you're going to face the question of when do you go back in, and you're likely to screw that up. And I'd let the traders, the hedge fund guys, make those gains. And I'd say something slightly different, which is be prepared for a bumpy November, December, January as the results get known. And you're going to have a lot of days where you're going to say, I should have sold, But if you're going to hold on to it, this is Jeremy Siegel's stock result, you're going to hold on to it 10 years, who cares, right? And I know I had to pick the wrong day, so get over it. But I do say you prepare for a bumpy November, December in asset pricing and capital markets in general, because there could be bad things happen. There could be quite bad things. Willie, the last thing I would say, and I think you would, I know your values, I think you'd share it, is I'd remind people that this thing is a long way over for a lot of human beings, many of them in our country and many of them abroad. I have my program in Philly, I help educationally, and my program in Kenya, I help. And I would just, and I'm sure you share this view, don't lose sight of the fact as we come up to the holiday season that the people on this call, on this web, are relatively blessed, and try to reach out and help somebody during the next whatever, because there are some people out there not just hurting in the general sense that there are always people hurting, but like really hurting. And I see that very vividly in Kenya, where they were always hurting, but now they're really hurting, and in the US as well. So I'm not trying to usurp your agenda, but I know your values, and I think you would echo that.
I echo it, and it's a great note to end on. So Peter, thank you very much for not only all of your input today, but also for ending our conversation on that note, because I think it's the exact right note. So to everybody on the call, thank you very much. I've got a great webcast coming up next week with Admiral McCraven, who many of you may have watched his commencement speech at the University of Texas, where he said, if you do one thing every day, make your bed. I will have Admiral McCraven on next week to talk about leadership, to talk about foreign policy, and to talk about the education of our college students during the time of COVID, given that Admiral McCraven ran the University of Texas system. So Peter, thank you again for joining me. And
thank you, Willie. Always fun.